what should you know, what can you know, and then what should you do? And too often, we all do this, I think, as human beings. We jump in and we immediately begin to act. And especially the most productive and most successful people among us, we are problem solvers. We are used to seeing a problem and jumping into action immediately.
Put that coffee down.
Creators are leaders. Be careful what kind of leaders you're producing here.
Helen, we're both in sales.
Let me tell you why I suck as a salesman.
They realized that to be in power, you didn't need guns or money or even numbers. You just needed the will to do what the other guy wouldn't.
I'm not leaving. The show goes on.
Well, hello there, friend. Welcome back to the Construction Leadership Podcast. I am your host, Bradley Hartman, and on this show, we bring you ideas and insights from across the construction industry every single week to help you lead more effectively. This episode is brought to you by the Simple Sales Pipeline. It is the fastest way to quantify and organize your future sales, to develop a reasonable and insightful and helpful sales forecast. And it can be done in under 30 minutes. Learn more at thesimplesalespipeline.com. Now, the mission of this podcast is to bring you ideas and insights to help you and your team lead better and grow your organization. And most of the time, that comes via a guest we have on the show who says something smart. And other times, like here, we will hear things, maybe listening to another podcast, and I will think, that's smart. That's a good angle. It's a good perspective that we should share more broadly. And then we're going to promote that. And that is what we're going to do here today as we sample a recent clip from an episode featuring Mr. Scott Galloway on his podcast, the Prof G Podcast. Now, who is Scott Galloway? He is the professor of marketing at the NYU Stern School of Business and the founder of Section 4, where he teaches strategy and brand strategy sprints. So Section 4 came on my radar. It's like a masterclass online training on unique things with very good videography and high quality talent. Kind of took that masterclass, but made it customized for business, featuring the best professors from business schools around the country. Scott is also a New York Times bestselling author of The Four, about 4 key technology companies, The Algebra of Happiness, Post-Corona, From Crisis to Opportunity, and his recent book, Adrift, America in 100 Charts. I read his newsletter each week, which is free. It's called No Mercy, No Malice. And I occasionally dip into, as you will hear now, his podcast, which is called the Prof G Podcast. So he talks about business. He talks about some politics stuff. He talks about how the world works. And I certainly do not agree with everything he says. However, I really appreciate the way that he thinks about things and the way that he articulates his generally strong feelings. And why I'm going to play here a 7 or 8 minute clip from a recent podcast he had is because they were talking about the market impact of Home Depot's recent earnings call. Now, here's a quick digression here on how this is relevant to you and what's in it for you. So as I was listening to Scott Galloway kind of talk about Home Depot's recent earnings and what it meant for home building and what it meant for construction, obviously that on its own was very relevant. Meanwhile, we have been going down the path, and you may have heard me talk about this NSAA, the National Sales Analytics Association, that we are launching, got our first 8 members lined up, as we partner with PhD experts in analytics to bring those into construction, whether it's lumber and building materials, whether it's commercial GCs. We're also helping some residential firms. How can we help them think better with all the data that we've got? And as I was thinking about Home Depot, I thought in a perfect world, I would be aware of what's happening to the stock price of Home Depot and maybe Sherwin-Williams and Pulte Homes and Lennar and Lowe's and these other firms in our industry, because that is a signal of some sort about what people expect the future to be. Now, there's this simple 3-question framework that has really helped me and our clients and shaped how we've built this NSAA, the National Sales Analytics Association, with 3 simple questions. And they are, number 1, what should you know? So what should you know about your business? What information is available that you should know? Number 2, what can you know? Because some things that you should know or would like to know just isn't available to be found out. And number 3, what should you do? So again, what should you know? What can you know? And then what should you do? And too often, we all do this, I think, as human beings. We jump in and we immediately begin to act. And especially the most productive and most successful people among us, we are problem solvers. We are used to seeing a problem and jumping into action immediately. We jump to step 3. What should we do? Without taking a step back and thinking, okay, what should we know? What can we know? And then what should we do? So as I was thinking about this framework from this analytics expert friend of mine, and then thinking of Scott Galloway talking about the Home Depot recent earnings, I thought, well, there's all these publicly traded companies where in a perfect world, if I had enough time and it was easily accessible, I would be aware of what their stock price is doing. So I tasked our analytics partners if they would be able to create for us our very own construction index. So what does that mean? Well, I said, well, let's break down into, say, 5 categories. We had commercial construction, we had residential construction, we had building material supply, building material manufacturers, and financial. So identify these companies that are publicly traded, lots of information that is available, and more of it comes out on a recurring basis. How could we aggregate that and visualize it in a way that helped me make more sense of the world and hopefully make better decisions on behalf of my own company and help our clients do the same? So for example, commercial construction companies, we got Fluor, we got AECOM, we have Jacobs Engineering, Kiewit, Quanta Services, MCOR, KBR, Mastech. Like those are all publicly traded companies. We've got residential construction, D.R. Horton, Lennar, Pulte, NVR, Toll Brothers, and Taylor Morrison. Building material manufacturers like Nucor, U.S. Steel, Sherwin-Williams, PPG, Mohawk, Weyerhaeuser, UFP Industries, Owens Corning, Boise Cascade. You get the idea. We also have building material suppliers, Home Depot, Lowe's, Builders First Source, Beacon Roofing. I'll throw in Fastenal in there, GMS. Again, all publicly traded. We can know that information. And last but not least, we have financial. So Fannie Mae, Freddie Mac, and I included Capital One. So anyway, we have all those organizations. They are putting out reliable, consistent data. My challenge for these analytics friends of ours was to put this together in a way that made it really easy for me to see what is happening over the last 30 days or 90 days or 5 years. What is happening in relative terms to their stock price? Is it going up or down? And what's that delta? And how can we make that easy? Long story short, we created our very own construction index. If you are interested in seeing this, this is an example of what we're able to do with analytics. And by the way, these analytics nerds came back with this thing in like 36 hours. And they're like, piece of cake. All that data is available. So what can you know and what should you know? It's all right there. And now the question is, what do we do with it? So it was really exciting to partner with them. And it's an example of how we're helping GCs and subs and certainly sales teams in the lumber building material industry think differently about the analytics and the data that's available to make smarter decisions and lead a better business. So if you're interested in seeing this construction index that has those 5 segments and the 30 plus companies that are publicly available, feel free to email me directly at bradley@bradleyhartmanandco.com. And it's really cool. You can toggle in and you can select different companies. So if you're interested to see Home Depot's earnings that Scott Galloway talks about compared to Lowe's, but also compared to D.R. Horton's. And I want to see what's going on with commercial as well. So I also want to include Kiewit and Fluor. All right, boom, right there. It can eliminate everything else. But the insights come immediately when you can visualize them. So we've had a lot of fun. It's been a really helpful tool and we are able to build it very quickly. Again, if you're interested, feel free to email me at bradley@bradleyhartmanandco.com. We'll give you access and you can play around with it for free and get an idea of what we're able to do with analytics. All right, With that being said, that is the background here. What you're going to hear now is Scott Galloway's perspective on Home Depot's recent earnings. It's a 7-8 minute clip or so. Very smart, intelligent guy, and I really enjoy his perspective. I don't agree with everything he says, and I will tell you, if you decide to dig into more of Scott Galloway's stuff, whether it's his newsletter or his podcast, he has some very strong beliefs. And if you get triggered by people saying very strong things that might implicate people on both sides of the aisle, this might not be the best for you. But he's thoughtful and he's got strong opinions. And quite frankly, we shouldn't be triggered by just what people say. That's not really helpful anyway. So without further ado, please enjoy this clip that I found valuable, and I think you will be smarter for listening to from Scott Galloway, a clip from a recent episode from the Prof G podcast. As always, thank you for listening.
We're back with Prof G Markets. Home Depot disappointed with its earnings last week. Sales were relatively flat, missing Wall Street's estimates, and the company also forecasted a drop in profits for 2023. The company cited a few reasons for this miss. First was lumber costs. Lumber prices surged last year, but are now down around 50% from a year ago. Second, wages. Home Depot will spend $1 billion in wage increases for its employees, which will have a negative impact on its margins. And finally, the economy. The CEO, Ted Decker, pointed out that people are spending more on services like travel and dining and experiences, and less on goods, in this case, home improvement products. Home Depot shares fell 7% after the call and ended that day with one of the biggest declines out of all of the S&P 500 stocks. Scott, what are your thoughts here?
My thoughts are what's bad for Home Depot shareholders is good for the world. And that is, there's this incredibly powerful force in the universe, and that is reversion to the mean. And that is, luck is almost perfectly symmetrical. And that is, if you have great luck around investment, that means you're due for bad luck and you should pull in your horns. When you have bad luck, I think that's the time to be most aggressive because it means you're due for good luck. And what I've just been blown away by is how the majority of trends have reverted to where they would have been had there been no pandemic. So if you look at e-commerce, if you just took the growth rate of e-commerce in 2019 and took it out another 3 years, you see this huge spike up, but then it's come down and it's exactly where it would have been on its own. And what we're seeing here is vicious reversion to the mean around the amount of money people are spending on their homes. When people were stuck in their homes 24/7, they decided we need to upgrade, we need to renovate. And all of a sudden it's like, no. Revenge travel. The last thing I want to do is be in my home. I experienced this at Section 4. We had this massive growth in 20 and 21 in online education. And then towards the end of 22, we couldn't get arrested because the last thing anybody wanted to do was be stuck in their house, staring at a screen, learning about brand strategy. And the business is probably where it would have been had we just kept growing the way we were growing pre-pandemic. So this is healthy regression to the mean or reversion to the mean. And the other thing I really like about this is that frontline workers in retail are getting a raise. And I like that. I think it's hugely overdue. If you ever see an organization putting its workers in commercials, that means they're underpaying them.
With courage in your eyes and determination on your mask-covered faces, and you continue to do it day in and day out. You are the ultimate doers, and who you are makes us who we are. We are the Home Depot, and we couldn't be more proud of you.
That means we're underpaying them. You don't need to be called a hero if you're paying someone a fair wage. They're fine not to be called a hero. So Home Depot, I like the stock going down here because it's a function of some healthy trends. One, young people and people getting out of their house, and two, frontline workers and retail employees making more money.
Just going back to the economy. So U.S. existing home sales, we just had some data come out. Existing home sales dropped for the 12th straight month just now, and it's at its lowest level in more than 12 years. And you've been describing that, people aren't investing in their homes as much, and we're going to see revenge travel. How long do you see this lasting? I mean, Home Depot is forecasting a massive drop in their profits, basically for the entire year. Do you think that that's an overprojection?
As it relates to home ownership, there was some very disturbing data that came out last week, and that is 1 in 3 houses nationally are purchased all cash, meaning the rich are ballers. Think about 1 in 3 houses. I think over half the houses in Naples, Florida were purchased for all cash. And at the same time, first-time home buyers have hit a record low, meaning young people can't afford homes, but older rich people can now pay cash. So this directly goes to income inequality and incumbents and advantage being ceded to old people at the expense of young people. We have a housing crisis because of this NIMBYist bullshit culture we have. It is so difficult to develop. And that is, once I have a home, I'm going to endorse and show up to the local architectural review board. And I mean, I'm not exaggerating. We bought a piece of property in Delray. We're planning to develop on it. And someone showed up to the local review board meeting and said, well, I like to walk my dog over there. And I'm like, okay, that's called trespassing. And they decided to delay the approvals 3 months to talk about where there's other places this lady can take her dog to shit and pee over my property. But the local boards have incentives. They all own homes, and everyone who shows up to the meeting owns a home. The people who don't show up to the meeting are young people who want to move there who can't afford a home. They don't show up and say, hey, I'm thinking about buying a home in Delray. Is there any way you could make it like not unaffordable for me by having more housing stock? We have a housing crisis. We have a crisis of too few freshman seats at colleges. And we have a crisis where it's hard for small companies to emerge past the big guys. And it all comes down to the same thing. The incumbents have weaponized government to their advantage. Once you have a home, a college degree, or a business, you don't want new entrants. And we need legislation that basically ensures that the law errs on the side of growth and new entrants. And that always gets people's hair on fire. What you're seeing in the housing market is more of a psychological phenomenon. That's in addition to just the raw economics where young people can't afford it. You're seeing the economic impact of higher interest rates. So the affordability, if you make, I don't know, $2,000 or $3,000 a month, or you can pay $2,000 or $3,000 a month for a mortgage, it's gone from you can afford $750,000 home to $500,000 home. So that just takes down, that's just a gut punch to the housing market. In addition, what we're seeing is this psychological impact of what I call just a standoff. And the standoff is the following. A couple who own a home think, okay, the Joneses 14 months ago got $700,000 for their home. That must mean my house is worth $720,000. And they ignore the data that as interest rates have gone up and housing prices have come down, no, your house is probably worth $550,000. They refuse to believe that. People always anchor off the high point. And meanwhile, the buyers are reading all this data and think they're going to come in and swoop in and buy something on the cheap. And what there hasn't been yet is there hasn't been capitulation or price discovery. And that is, I was looking for a home in Colorado. I love it there. I've seen the inventories build dramatically, but there's nothing trading hands. Because again, the sellers are still want to believe that it's early 2022 or late 21. And the buyers want a crash. The buyers think a crash has happened. And it's somewhere in between. But I would bet in 2 to 3 quarters, you're going to start to see capitulation. People need to move, the death, divorce, disease, whatever it is. And you'll see stuff get repriced. The good news is housing prices need to come down. Young people need to be able to afford homes. So I'm hoping that home prices do come down substantially. Now, if you bought a home in the last 2 years, that's going to be bad for you. There's always pain, but there's just no getting around it. A great means of saving is to own a home. It's a point of pride for people. And young people can afford them. So I'd like to see housing prices come way down.
Well, here's a tiny little piece of good news. Biden is cutting mortgage insurance costs for new home buyers insured by the Federal Housing Administration. It's only cuts costs by $800 a year. That's 0.3%. But it's something, and perhaps it'll slightly move the needle on this housing issue.
All right, friends, how did that go? Hopefully you enjoyed that clip. If you want to hear more or learn more from Scott Galloway, you can check out the Prof G podcast. His newsletter is, it's a little bit lengthy every week, but it's good. I normally will read it in full, at least once, if not 2 or 3 times a month. It's called No Mercy, No Malice. And his book, Post-Corona, I thoroughly enjoyed as well. So he's funny, he's smart, he's our type of guy. So I will leave it at that. Again, if you are interested in seeing this analytics tool that we created that has the 5 different segments that are relevant to our construction industry, commercial construction, residential, building material manufacturing, building material supply, and financial firms that are all relevant as you think about this 3-step framework, what should you know, what can you know, and what should you do? This is a tool that we've built. It's available. I'd be happy to give it to you if you are interested. So again, feel free to email me directly at bradley@bradleyhartmanandco.com. Also relevant here, if you are interested in leveraging data in unique ways to lead better, grow your business better, and you know you're not taking advantage of analytics and what they can do and developing predictive analytics for what you think is going to happen in the future, and you're still relying on Excel documents and Google Sheets and writing notes in the back of bar napkins, I do believe that we can help you. We have partnered with a pair of PhDs in analytics, and they are smart and they are really helping us and our clients think better about how to leverage analytics to grow their business faster. So again, if you're interested in there, I can give you some context of what we are doing there. So again, this episode is brought to you by the Simple Sales Pipeline. You can learn more at thesimpleSalesPipeline.com. That's all I've got. Have a great week. We're going to close out like we always do. You, my friend, are owed nothing. Deliver value first.